Hey everyone, before we dive in, here's something really cool. You're listening to an episode created almost entirely by AI. From the script to the voice, this is part of the AI Takeover series by Blockchain DXB, where we explore what's possible when humans hand over the mic to machines. There's little to no human involvement, and that's what makes this episode so powerful. Welcome to the future of content creation. Let's get into it. This episode is powered by Amana, the region's first and fastest growing regulated all-in-one trading and investing app. Whether you're looking to invest in US stocks like Apple or Tesla, or MENA giants like Adinoc or Salik, Amana puts the financial market at your fingertips. You also get access to gold, foreign exchange, ETFs, futures, and commodities. With over 375 assets to choose from, they've got the largest crypto selection in the region. And listen, guys, if you want to build long-term wealth without thinking about it every day and want to automate your investing, just set your monthly budget, choose your preferred categories, and let Amana do the rest. No fees, no lockups, and 100% customizable. Even better, funding your account is frictionless, and funding your account is easier than ever. You can fund your account with Apple Pay, Google Pay, credit cards, instant bank deposits, and even your crypto wallet. No friction, no hassle. And if you get stuck, Amana offers 24/6 real human customer support and personalized sales assistance. Because you're part of the Blockchain DXB community, you get an exclusive offer. Register with the code BlockchainDXB and make at least one trade to receive a $100 trading bonus credited to your account the following month. So what are you waiting for? Download the Amana app now. The link and code are in the show notes. Next up, Blockchain DXB is proud to be the official media partner for one of the biggest blockchain events of the year, the Blockchain Futurist Conference. For the first time ever, North America's leading crypto event is heading to the United States, taking place at the iconic Guitar Hotel at Hard Rock in Hollywood, Florida. Alongside it is ETH Women, happening simultaneously. Expect multi-stage panels, NFT galleries, DeFi showcases, tech demos, metaverse experiences, and more, all under one roof. It's where the smartest minds in blockchain, crypto, and AI will converge. Get 25% off tickets by using the code DXB25. And yes, I'll be there with exclusive live coverage, behind-the-scenes interviews, and spotlight features on groundbreaking projects. Mark your calendars, November 5th and 6th, 2025. Visit futuristconference.com and use code DXB25. Link is in the show notes. Next up, Blockchain DXB has two more interesting partnership news to announce. First up, with Future Blockchain Summit and Fintech Surge 2025. Blockchain DXB is an official media partner of Future Blockchain Summit and Fintech Surge 2025. Future Blockchain Summit is one of the biggest and oldest blockchain summit taking place in Dubai, going back to almost a decade, 2017 to be precise. The event takes place between October 12th to 15th at Dubai Harbour. This is where blockchain meets fintech to redefine the future of finance. 250 plus world-class speakers, 1,200 plus investors, live demos, product launches, and the exclusive invite-only GITEX Digital Assets Forum, all under one roof. From Web3 pioneers to fintech leaders shaping payments, banking, insurtech, AI, and DeFi, this event brings the entire ecosystem together. Startups, this is your launchpad. Get in front of top VCs, accelerators, and industry leaders. For blockchain and fintech companies, this is where connections turn into partnerships and dreams turn into exits. Register today at futureblockchainsummit.com. Don't just watch the future unfold, own your space in it. Remember, Future Blockchain Summit and Fintech Surge 2025. The registration link is in the show notes below, and see you at Dubai Harbour. Second partnership news kicking off from today is with the leading Bitcoin event organizers on this planet. And this year, Bitcoin Asia is taking things to another level. Bitcoin Asia are hosting a massive gathering this August in Hong Kong, and Blockchain DXB is proud to be an official media partner of Bitcoin Asia 2025. Taking place this August in Hong Kong, Bitcoin Asia is the region's premier Bitcoin gathering, where builders, investors, and innovators meet. It's really an honor for Blockchain DXB to be associated with Bitcoin Asia. Now at this event, expect powerful keynotes, bold conversations, and a headlining session with none other than Eric Trump. He will be sharing his vision for Bitcoin's long-term potential, its role in global finance, and Asia's massive impact on adoption, and a lot more. So listen up, guys. From infrastructure to regulation, privacy tools to lightning development, Bitcoin Asia connects global Bitcoin communities and drives innovation across cultures and markets. And as part of this partnership, you can register for the Bitcoin Asia using the code DXB. All the details are in the show notes below. If Bitcoin's in your blood, this is your event. So, register today at asia.btc and don't forget to use code DXB for 10% off your tickets. Bitcoin Asia 2025, Hong Kong is calling. Be part of the future of Bitcoin. Next up, Advanced Media is the largest distributor of professional video, photography, cinema, and broadcast accessories in the Middle East. They represent over 100 major brands, including DJI, Hasselblad, Red, and Rode. The mic I'm using to record this? Sponsored by Advanced Media. But what really sets them apart is their commitment to purpose. People, planet, and prosperity. That's not just branding, it's their actual business model. They've partnered with SAE Institute in Dubai to offer scholarships to students pursuing a bachelor's degree in filmmaking, each worth AED 50,000. They also run regular workshops, training programs, and tech showcases across the region. For more info, visit amt.t, that's amt.tv. Finally, let's talk about something every crypto investor should take seriously: security. And that's where Ledger comes in. Ledger is one of the most trusted names in crypto security. Their hardware wallets, like the Nano S Plus and Nano X, keep your assets safe by storing your private keys offline. That means you're protected against hacks, malware, and phishing attempts that can compromise online wallets. The company is headquartered in Paris and is constantly innovating. Their team works with world-class security researchers and regularly tests their own products for vulnerabilities. It's why Ledger wallets are used by millions around the world. Using a hardware wallet isn't just smart, it's essential. If you're serious about crypto, it's time to stop relying on centralized exchanges or browser wallets. Click the link in the show notes to order your Ledger wallet and support this podcast at the same time.
You know, there's an old saying on Wall Street that I keep thinking about whenever we hit a patch like this one.
Let me guess. The market takes the stairs up.
And the elevator down.
Yeah. And if you were brave enough to look at your portfolio this morning, it probably felt like the elevator cable just snapped and you were in total free fall.
It really, really does. Welcome to the Deep Dive. We're looking at the markets for January 26, 2026. And listen, we're not going to sugarcoat it.
No.
It is ugly out there. We've got Bitcoin slipping below some major psychological safety nets, lines on charts are breaking, and the general vibe on X, formerly Twitter, is somewhere between mild panic and end of days.
It's just a sea of red. I actually checked the sentiment scores right before we started recording, and the fear and greed index is sitting at a 34.
Ooh.
That is firmly in fear territory. It is definitely a don't look at your phone kind of day for the casual investor.
But, and this is exactly why we do these deep dives, if you can just manage to look past the bleeding charts for 20 minutes, there is a completely different story happening.
Right.
It's almost schizophrenic. On one screen, prices are crashing, everyone is screaming. On the other, you have U.S. states trying to pay salaries in Bitcoin, European banks banding together to invent their own digital cash. And, I mean, the Middle East is basically trying to put the entire energy industry on the blockchain.
That's the fundamental contradiction of the cycle we're in right now. The price action is screaming recession and whisk off, but the infrastructure build-out is screaming mass adoption.
The pipes are being laid even while the house is shaking.
Exactly.
So today, our mission is to fight that urge to sell everything and hide under the bed. We are going to unpack this split-screen reality. We'll look at why Oklahoma wants to be your payroll department, why India is effectively banning financial privacy.
And why a group of European banks are suddenly holding hands to fight off American stablecoins.
And we'll finish with, I think, a fascinating look at the Middle East, specifically Saudi Arabia and Dubai, where the focus has shifted entirely from just trading coins to tokenizing the real world.
It's a big shift.
Let's start with the pain, though. We have to address the elephant in the room because it's what everyone is staring at. The market meltdown. Give us the damage report. Just how bad is it?
It's significant. The headline number that everyone is watching is the total market cap for Bitcoin. It's fallen below that $3 trillion threshold.
Okay.
Right now, it's hovering at about $2.99 trillion. In the last 24 hours alone, we've seen a drop of about 3.4%.
And for the people who just track the price of a single coin, where are we sitting?
Bitcoin is trading around $86,187, but the pain isn't evenly distributed, you know? Ethereum has taken a much harder hit, dropping to around 2,793.
Wow.
And Binance Coin, BNB, is down to about 629.
So, okay, everything is down, but usually there's a catalyst, right?
Yeah.
Is this just normal volatility, or did something specific trigger this sell-off?
It looks like a combination of macro factors, but the immediate trigger, the thing that really kicked it off, is institutional outflows.
Yeah.
We track the money flowing in and out of the spot ETFs.
Right, the exchange-traded funds.
Exactly. The ones that let big traditional investors buy Bitcoin without, holding the keys. And the numbers are stark. Last week, we saw over $1.5 billion in outflows.
$1.5 billion.
And just in the last 24 hours, another 142.7 million left the building.
That is a lot of institutional money saying, no thanks, not today. Why now?
It's a classic risk-off environment. Global uncertainty is high, interest rates are fluctuating, and when big investors get scared, they pull liquidity from the riskiest assets first. And crypto, despite all the adoption, is still considered a risk asset.
Right.
And there's a nuance here that a lot of retail investors miss, and it's vital for understanding the market dynamics.
Which is?
While the price of Bitcoin is dropping, Bitcoin dominance has actually increased. It's up to 57.6%.
Okay, let's clarify that term, because we hear it a lot. Bitcoin dominance is the percentage of the total crypto market cap that is just Bitcoin, correct?
Correct. If you took all the money in crypto, 57.6% of it is currently sitting in Bitcoin.
So if the price is going down, but its dominance is going up, that means people are selling everything else faster than they're selling Bitcoin.
Exactly. In a crashing market, Bitcoin is seen as the safest house in a bad neighborhood. Investors are fleeing altcoins, the smaller, more volatile tokens, and they're parking whatever value they have left in Bitcoin.
A flight to safety, relatively speaking.
Right. If you're holding a small cap coin, you might be down 10-15%. If you're holding Bitcoin, you're down 3%. That's the logic.
It's so interesting that Bitcoin is now the safe haven within its own ecosystem. It used to be the volatile one. Now it's the boring grandpa compared to the rest of the market.
Well, that's a sign of maturity for the asset class. But this shift is wreaking havoc on the DeFi sector. The total value locked, which is basically the amount of money deposited in these protocols for lending or trading, has dropped below $120 billion.
Where's it at now?
It's sitting at around $117.79 billion.
And what about volume? Are people still using these decentralized exchanges, or are they just running back to the big corporate ones?
They are running back. If you look at the volume on decentralized exchanges versus, say, Coinbase or Binance, the decentralized share is only about 29%. When panic sets in, people want a customer support number, or at least a centralized entity they feel is more robust. They're moving to the sidelines, into cash on the big exchanges.
That's the gloom. It's bad, but it's rational market behavior. Now, I want to pivot to something that feels like it's from a different timeline. While everyone is selling, the state of Oklahoma is apparently drafting legislation to pay people in Bitcoin. This feels
a little counterintuitive.
Yeah, right.
Well, this is the tale of two regulations we're seeing globally. On one side, you've got Oklahoma. There's a new bill, Senate Bill 2064, introduced by Senator Dusty Deevers.
Dusty Deevers. You have to love American political names. It sounds like a character from a Western.
It is memorable. But his bill is actually pretty sophisticated. It proposes allowing state employees and businesses to receive salaries and payments in Bitcoin.
So, hypothetically, if I work for the Oklahoma Department of Transportation, I can opt to get my paycheck in BTC.
Under this bill, yes. Now, to be clear, it does not make Bitcoin legal tender.
Okay. That's an important distinction.
A huge one. You can't walk into a grocery store in Oklahoma City and force them to take your Bitcoin, and you can't pay your state taxes with it, not yet. But it recognizes it as a valid transaction method for state business.
That distinction matters. It's the state saying, we acknowledge this asset has value, and we are willing to help you hold it.
Precisely. It legitimizes the asset. But there are some pretty big caveats that show how early we still are.
Like what?
Well, the bill says the state treasurer isn't going to, set up a hardware wallet and hold the keys. They have to hire a third-party firm to actually handle the payments. The state doesn't want the custody risk.
That makes sense. You don't want the treasurer losing the seed phrase for the state payroll on a Post-it note.
Exactly. And maybe the most bureaucratic part of this whole thing, there won't be any specific tax guidance on this until January 1st, 2027.
Oh, that is a nightmare waiting to happen. Here's your volatile asset. Good luck guessing how to report it to the IRS for the next 2 years.
It creates a lot of friction, but the signal is what matters. A U.S. state is trying to integrate Bitcoin into the public payroll. Now, contrast that with what's happening in India.
Right.
Because while Oklahoma is opening the door, India is slamming it shut, but only for a very specific type of crypto.
You're talking about the privacy coins.
That's right. India's Financial Intelligence Unit, the FIU, is cracking down hard on assets like Monero, Zcash, and Dash.
Okay, we throw these terms around a lot, but let's do a quick explain. Like, on 5, why would a government hate Monero but seem okay with Bitcoin? Aren't they both just crypto?
They are, but they function very, very differently when it comes to transparency. Bitcoin is a public ledger. If I have your wallet address, I can see every single transaction you've ever made forever.
Governments love that.
They love that. It's a surveillance stream for tax enforcement, for tracking crime.
Right. Bitcoin is pseudonymous, not anonymous. If they can link the wallet to you, they know everything.
Exactly. Monero is different. It uses cryptographic techniques, things like ring signatures and stealth addresses. Without getting too technical, just imagine if every time you signed a check, you also forged 10 other people's signatures on top of it so no one knew which one was real.
So it's truly untraceable.
And that terrifies regulators. They are worried about money laundering, terror financing, tax evasion. So India has directed all registered exchanges to stop deposits, withdrawals, and trading of these coins immediately.
Immediately is a strong word in regulation. Usually there's a grace period. What did that do to the market for these coins?
It decimated them. Monero is down 41.5% from its all-time high, largely driven by this kind of regulatory pressure. Zcash is down 10.4%. It's a clear signal. Governments will tolerate crypto, but they are declaring war on anonymity.
It really highlights the tension at the heart of this industry. You have the transparent crypto that gets integrated in Oklahoma and the private crypto that gets regulated into oblivion in India.
And it raises a philosophical question for you, for the listener. Is the future of crypto just digital transparency?
Yeah.
If the only crypto that survives is the kind the government can track, have we lost the original cypherpunk vision?
It's a great question.
Because right now, the market is voting with its feet and privacy coins are losing.
Speaking of losing, or maybe winning, depending on whose side you're on, let's talk about the banks. Because for years, the narrative was bank the unbanked and be your own bank. But now, it looks like the legacy banks are saying, actually, we'll just be the bank, thanks.
This is a massive development coming out of Europe. We have a consortium of 10 major European banks forming a group called Cavalis.
Cavalis. It sounds like a secret society in a Dan Brown novel or something.
The member list is certainly elite. We're talking ING, BNP Paribas, Danske Bank, Unicredit. And the leadership is fascinating. They're being led by Jean-Olivier Vell, who is the former CEO of Coinbase, Germany.
So they hired a crypto native to run the bank coin. Smart.
Very smart. And it's chaired by Howard Davies, the former chair of NatWest Group. So you have the crypto tech expertise combined with some heavy institutional banking weight. And their goal is to launch a euro-pegged stablecoin in the second half of 2026.
Okay, play devil's advocate for me here. We already have stablecoins. We have USDC, we have Tether. They work fine. Why do these banks need to spend millions building their own?
It's about sovereignty and currency control. Right now, the stablecoin market is almost entirely dominated by American companies issuing dollar-backed tokens. If you're a European bank or the European Central Bank, you do not love the idea that the future of digital money is entirely dependent on a U.S. company like Circle or Tether.
So this is Europe trying to reclaim the digital payments rail.
Exactly. They want a digital euro that they control, and they see a gap in the market. The current volume of USDC is under $10 billion globally. The banks look at that and think, we process trillions, we can take this market.
But doesn't this kind of defeat the purpose? I mean, the whole ethos of crypto is peer-to-peer permissionless transfer. If a consortium of banks issues a coin, can they just freeze it whenever they want?
That is the controversy. Yes, they absolutely can. In fact, most stable coins, even USDC, have freeze capabilities written into the code.
Right.
But a bank consortium coin is the ultimate centralization. It's essentially just updating the banking backend to use blockchain for efficiency, rather than creating a new open financial system.
It feels like we're watching the gentrification of crypto.
Yeah.
The banks are moving in, renovating the neighborhood, putting up nice fences, and raising the rent.
That's a perfect analogy. And for the user, it might actually be better in terms of safety insurance, but it is definitely not crypto in the revolutionary sense.
So we have the market crashing, regulators fighting over privacy, and banks building their own walled gardens. It feels like a good time to look in the rearview mirror. We have some data from CoinGecko reviewing the state of crypto for 2025. And honestly, some of these numbers explain why the banks are making their move now.
It's a fascinating report. It really puts the current sentiment into context. The headline stat that jumps out is that the total crypto market cap actually fell 10.4% in 2025.
So last year was officially a down year.
It was. But what makes it painful is the comparison. Gold, the physical rock, surged 62.6% in 2025.
Oof. So the digital gold narrative took a beating from actual gold.
It really did. In a time of global uncertainty, people went back to what they knew. When things get scary, shiny yellow metal you can hold in your hand still wins the store of value war.
But there must have been bright spots.
Oh, yeah, and they point to this infrastructure trend we keep mentioning. The stablecoin market cap grew 48.9%.
That's interesting. So people aren't buying the volatile coins, but they are holding more cash on the blockchain.
Exactly. It shows people find utility in the rails of crypto moving dollars or euros around fast and cheap, even if they don't want to gamble on the price of Bitcoin. But here's the stat that stood out to me the most, and it signals a shift in human behavior. Prediction markets grew 302.7%.
300%. This is platforms like Polymarket, where people bet on elections or sports outcomes.
Yes, and it highlights a massive shift. People aren't just holding coins as a store of value, they're using them to bet on the outcome of reality. It's becoming an information layer.
So when the news is unreliable,
People look at where the money is betting.
it's the monetization of truth, or at least the monetization of what people think is the truth.
Correct. And that volume is sticky. People might stop trading Dogecoin, but they won't stop betting on the US election or the World Cup. It provides a real utility information discovery.
True. Okay, let's get out of the numbers and fly over to the Middle East, because every time we cover this region, it feels like they're operating on a completely different playbook. While we're worrying about price drops, they're building smart cities.
It is a completely different vibe. The narrative in Dubai and Saudi Arabia isn't about trading. It's about physical infrastructure. First up, we have news from Dubai. An AI security firm called Hatta is opening a major office there.
Verkada, I know them. They do those cloud-connected security cameras, building access systems.
Correct. They're valued at $5.8 billion after a recent investment. They've appointed Fred Kohan, a tech veteran with 25 years of experience, to head up the Middle East.
Why is a security camera company headline news for a crypto deep dive?
Because Dubai is aggressively building smart cities. To have a city that runs on blockchain and AI, you need sensors. You need cameras. You need the physical layer that feeds data into the system.
I see.
This aligns perfectly with the region's focus on high-tech urban planning. They're building the hardware that the blockchain software will eventually control.
So that's the physical infrastructure. But there's financial infrastructure being built next door in Saudi Arabia. And this story, I think, is the sleeper hit of the episode. This is real-world assets.
I agree. This is the open world announcement. They're launching a center of excellence for real-world asset tokenization in Al Khobar.
Real-world asset tokenization. Buzzword soup.
Yep.
Break that down for me. What are they actually doing?
They're supporting Saudi Arabia's Vision 2030. The goal is to take massive, tangible assets. We're talking energy grids, huge real estate developments, carbon credits, and represent them as tokens on a blockchain.
So instead of buying a meme coin with a dog on it, I could technically own a fraction of a solar energy project in the Saudi desert.
That is the vision. It turns illiquid assets, things you can't easily sell, like a power plant, into liquid tokens that can be traded globally 24/7. And they are not doing it alone. This initiative is backed by absolute giants in the venture capital space. Andreessen Horowitz, A16s, Founders Fund, Dragonfly.
Those are the smart money names. If A16s is backing a tokenization center in Al-Khobar, they clearly see this as the next frontier.
They do. The takeaway here is that in 2026, the trend is moving away from purely speculative assets and toward tokenized infrastructure. It's about putting the global economy on chain, not just creating new currencies.
It connects back to what we saw with the banks in Europe. The technology is being adopted, but the Wild West aspect is being paved over.
Precisely. We are seeing the professionalization of the space. Saudi Arabia is creating a standardized framework for this. They want to be the global hub where you go to tokenize $1 billion worth of real estate, legally and securely.
Which is a lot less exciting than Bitcoin to the moon, but probably a lot more sustainable in the long run.
It's the difference between a casino and a stock exchange. One is fun, the other runs the world. And right now, the smart money is betting on the stock exchange model.
So, let's wrap this up. We have a market that is currently bleeding out. Bitcoin's under $3 trillion, fear is high, ETFs are dumping. But at the exact same time, Oklahoma wants to pay you in crypto, European banks are building their own stablecoins to fight the dollar, and Saudi Arabia is tokenizing the energy grid.
It's a paradox. Price is down, adoption is up. But note the type of adoption. It's institutional, it's government-led, it's regulated.
And that leads to the big question for you listening right now. If the future of crypto involves bank-issued stablecoins, government-monitored transactions where privacy coins are banned, and tokenized corporate assets, are we moving toward a world where crypto succeeds, but decentralization fails?
It is a provocative thought. We might get the technology we wanted, fast, digital, global, but maybe without the freedom we were promised.
Something to think about while you stare at those red charts. Stay curious, look for the utility, not just the price, and we will catch you on the next deep dive.